What up? It's your boy Willie G. In this video, we'll be discussing a new investor's note that was put out today from Morgan Stanley's very own Adam Jonas. I'll be going over the note, try to provide a bit of context around what Jonas is saying, as well as provide my own thoughts about what he's saying. But before we begin, be sure to subscribe to the channel and tap the bell to be notified of all the latest content as soon as it drops. So with that, let's get to it. Thoughts on reportedly leaked Elon Musk tough quarter email. Tesla investors have become accustomed to the occasional communication from Elon Musk to his employees trying to, quote, rally the troops during difficult quarters. According to multiple media sources, although unconfirmed by Tesla, this has happened again and just on the heels of Mr. Musk's warning on the global economy around 10 days ago. What should investors make of this? Given the extraordinarily high dependence of Tesla on China production, greater than 40% of global production and profitability, we estimate well over 50% of Tesla profit from China. The disruption from local COVID lockdowns is understandable, if not fully in consensus forecasts at this time. But as Tesla has shown throughout its history, it can make up substantial lost ground with accelerated deliveries into the close of a quarter, where disproportionate amounts of a full quarter's production can occur in the final week or two. Additionally, what may be lost in second quarter could just provide pent-up sequential tailwinds for third quarter results. So what is Adam saying here? Investors and analysts are aware of China's impact on Tesla's numbers, likely already modeling this into their forecasts. He also notes that Tesla is not unfamiliar with similar situations and will likely be able to make up significant ground. Now, while they don't believe that they'll beat previous expectations, they may be able to beat new ones. So with their previous track record over many years and quarters, Tesla has proven this ability. They understand the challenges and will look to overcome them. And I wouldn't be surprised if they came up short of their previous internal goals for the quarter, but do end up near previous external expectations. Meaning, I believe that maybe Tesla doesn't reach what they thought they could have at the beginning of Q2, but it's likely that they may even surpass what previous expectations from the consensus were at the beginning of second quarter, where they've now been adjusted lower based on factors outside of Tesla's control. But there's no doubt that they'll pick up the pace and surprise many people when the third quarter rolls around. Our thoughts. It's very prudent to shift some production and EBITDA from second quarter to third quarter. Consensus forecast of less than $18 billion total company revenue appears to discount a sequential quarter-over-quarter decline in delivery volume to below 300,000 units for the second quarter. Any lingering impact of the Shanghai lockdown on Tesla production probably resolves itself before year-end. So to break this down, based on the consensus forecast of less than $18 billion in revenue, Morgan Stanley believes Tesla will deliver less than 300,000 vehicles in second quarter. Shanghai impact may continue into the third quarter, so it would be forward thinking to push some of the production and earnings before interest, taxes, depreciation, and amortization, EBITDA, into Q3. So to me, Q1 shows how many vehicles they're able to produce in spite of the various stoppages that they had, such as the Chinese New Year. Part of the COVID lockdown started at the end of Q1, but they were able to produce greater than 65,000 vehicles in March, which was the second most out of China, only to December of 2021, prior to stoppages and all that. Now, they're likely deducing their numbers by using simple arithmetic to calculate the number of vehicles based on past performance. However, as mentioned, Tesla is capable of pulling a rabbit out of the hat. Not quite sure I understand the logic of pushing the EBITDA and production into Q3. If you do, be sure to let me know down in the comments below. I'd love to get your take on it, but my guess would be it's to help pump up the Q3 numbers to avoid any more potential negative pressure from lingering Shanghai effects. Another point to this is that the price increases that Tesla talked about on the Q1 earnings call will start to take effect over the next coming quarters. This is in addition to their ability to realize parts of their deferred revenue from the FSD beta expansion, where every time they release a new feature of the full self-driving software, they're able to realize some of the deferred revenue from that. So in a situation like this quarter, where they may not be able to push out as many vehicles, they are able to keep their revenue numbers up by realizing some of that FSD expansion, as well as the price increases that they had mentioned back on that earnings call. Sensitivity of a 25,000 unit delivery disruption. Assuming a $50,000, I assume he's saying ASP, not ATP. ASP would be average selling price, not sure what ATP is, but assuming a $50,000 average selling price per vehicle and 35 to 40% variable margin would impact pre-tax earnings by $44 million to $500 million, or roughly 10% of the current second quarter EBITDA forecast. Our current 25.8% second quarter auto gross margin is based on deliveries of 317,000 units. Removing 25,000 units, approximately $1.3 billion of revenue, could reasonably trim at least 50 basis points from our margin. So all this being said here is, as a point about discounting of deliveries, this could result in auto gross margin reductions by about 0.5%. Now, to me, in the grand scheme of things, a 0.5% isn't the end of the world, especially in light of the macro environment, such as the supply chain issues, inflation, economic uncertainty, but it could always be worse. They could be a floundering startup on the verge of bankruptcy, but they can ride this wave because of their available cash on hand plus the cash flow that they bring in. So in short, Tesla doesn't really have much to worry about from a cash perspective. Other considerations for second quarter margin pressure at Tesla. According to the reportedly leaked Elon Musk email, Berlin achieved almost 1,000 units last week and continues to spool up Austin. While we expect both Berlin and Austin to achieve gross margins closer to Shanghai levels than Fremont levels, we would allow for near-term margin pressure as both plants are ramped up. And on battery cost inflation, we would anticipate Tesla's suppliers to begin passing on higher material prices that were not fully reflected in strong first quarter results. But according to our China battery team, cattle prices may have still remained low for much of second quarter results, delaying the impact on Tesla. So what's being said here is that Berlin and Austin are not adding a substantial number of units to offset costs and meaningfully increase operational gross margins, and that battery cost inflation will increase as suppliers begin charging more for being charged more. Now, I'll admit this is a fair point. 1,000 units per week out of Berlin and spooling up of Austin would seem to indicate that they are running at less than peak capacity. This won't have as positive of an effect on margins as it will once production is fully ramped, but on the other hand, it could be higher than what is expected nonetheless. A word on BYD battery supply to Tesla. According to CNBC, BYD will begin supplying Tesla with batteries very soon. According to our China battery team, BYD would supply its large format, aka Blade, prismatic battery with LFP chemistry manufactured in China for Tesla vehicles assembled in Europe. As more OEMs like Tesla shift incremental battery supply to LP chemistry, less energy dense but safer and lower cost, it is understandable that Tesla seeks to diversify its supply relationship to not become overly dependent on one partner. Morgan Stanley China battery analyst Jack Liu explained this in his note, A Tale of Two Kings. LFP battery is more like a commodity in our view, and many Chinese producers are able to manufacture qualified products for auto OEMs now. A bear case includes the possibility of BYD wanting to take more share at Tesla than cattle by offering a slimmer margin. Multiple LFP battery producers are planning to double to triple volume this year. Before the next generation LFMP, lithium ferrous manganese phosphate, the LP battery market is likely to see intense pricing competition this year, since most publicly listed battery companies in China have guided for a double to triple battery sales this year from the level last year versus Morgan Stanley EV sales forecasts of about 50% year-over-year growth in China. So what he's saying here is Tesla's looking to diversify battery supply to avoid supply issues in the future, and that BYD may look to further ingrain itself in Tesla's supply chain in a bear case scenario, such as a situation where they can't secure from other suppliers, and that LFP battery production is expected to far outpace EV deliveries this year, based on Morgan Stanley's forecasts. Now, Tesla has yet to confirm this report from CNBC, but they have expressed desires to secure as many batteries as possible. It wouldn't surprise me that they're attempting to secure as many batteries as they can currently get their hands on. This is actually a bullish sign, as it could indicate Tesla's desire to continue increasing output rather than slowing down pace. It should be mentioned that with increasing of the 4680 supply output, both internally and through some external partners like LG and Panasonic, they could begin far outpacing the competition. So all in all, this note is not really saying too much that those who follow Tesla don't already know. I think Adam is kind of reiterating a lot of information that most people are aware of already. But I do think that this could be useful information for the average investor who does want to have a better understanding of where the company is going over the next couple of quarters. So that about does it for this video. If you guys enjoyed this or found any of this information useful, please be sure to like, share, subscribe. Also, don't forget to tap the bell to be notified of all the latest content as soon as it drops. Thanks for tuning in to the Willie G Show. Catch you on the next one. Peace.